This is my final presentation about accounting standards updates, and I chose franchisers' revenue from contracts with customers. So first, how the FASB has changed U.S. GAAP through each specific amendment to the FASB codification. This helped establish a comprehensive framework for revenue recognition. This requires franchisors to assume performance obligations and recognize accordingly with the ASU 2014-09 topic 606. In response, concerns from private franchisors was a big thing. Amendments provide a practical expedient to help simplify revenue recognition for the pre-opening services, and this allows franchisors to treat specific pre-opening services as a distinct from their licensings, reducing complexity and financial reporting. And this was ASU 2021-02 subtopic 95-606. And FASB hopes that these changes reduce the burden on privately owned franchises while having consistent revenue recognition practices. B, when will the change be effective in the transition method they identified? So it'll be effective December 15, 2020, and it has to be adopted by topic 606. And this is an existing transition provisions, and the effective date in paragraph 606, 10, 65, 1 are required. But the board also chose guidance that allows for an option of a modified retrospective transition or a full retrospective transition. This was to make it as smooth as possible for all the businesses. See why the FASB decided to change U.S. GAAP and provide some background information related to the change. So, to ensure financial reporting remains aligned, relevant, and transparent with upcoming business practices and regulations, and typically to come from economic shifts, stakeholders typically come from economic shifts, stakeholder feedback, and the need for large consistency in financial statements. And some background on that, addressing stakeholder concerns. They often focus on reducing complexity while keeping financial statement integrity. FASB evaluates feedback from businesses, investors, and auditors to help refine their standards. Improving presentations and disclosure worked to simplify financial statement disclosures by removing outdated requirements. Some updates work with U.S. GAAP and the section regulations to ensure consistency, and enhancing revenue recognition. This was introduced by topic 606. This aimed to create a uniform framework to recognize revenue through industries, and amendments such as ASU 2021-02 address the concerns from private franchisors. They offer practical expedients to ease their compliance. Section D of the project, my first company I chose was McDonald's. The reason was they operate in large franchise networks. Most of the McDonald's you go to are franchise-owned rather than corporate-owned. And this has a high impact on changes in revenue recognitions for their pre-opening services and initial franchise fees. And they had to reassess how to recognize revenue from the franchise agreements under Topic 606. So the impact on their financial statements was before, when McDonald's opens a new franchise, they just recognized all of those initial franchise fees right then and there up front. But after, because of Topic 606, they had to defer revenue recognition, and this spreads over the whole franchise term. This caused lower upfront revenue, but higher consistent earnings over time. My second place I chose was Domino's Pizza, and they heavily rely on the franchise agreements. And this has a sensitive time when changes do happen to the revenue recognition policies. But they had to adjust how it helped. They had to adjust how it helped being accounted for pre-opening service-wise, and that provided to all of its franchises. And the impact on financial statements was before recognized specific pre-opening services as a separate item from revenue streams, but afterwards, because of ASU 2021-02, it helped Domino's bundle pre-opening services into a single performance obligation, and this alternated revenue timing and provide more simplified reporting on their end. And the last place I chose was Planet Fitness, and Planet Fitness, like McDonald's, operates heavily on their franchise business model. So directly affected by Practical Expedient, introduced by ASU 2021-02. And they had to think about how they would account for training services and initial franchise fees. So their impact on their financial statements was before they recognized initial franchise fees upfront and recorded / accounted for training services separately. But now we're able to bundle all the training services together with their franchise license, and this helps lead to a more deferred revenue recognition. So their comparative impact, McDonald's started to see a shift in revenue timing. This affected short-term earnings, although it stabilized the long-term revenue stream, which is good in the long term, so that way their revenue seems more consistent. Domino's had benefits by having simplified reporting, although they had to adjust their financial disclosures, but it ended up being more simplified in the long run. Planet Fitness had a great experience on their deferred revenue, affecting their cash flow projections way more positively than in the past. Section E of the project. So the first section was adapting. Training and security updates, more investments in staff training and accounting system upgrades to help align with new standards. The second one was revised accounting policies. Franchisors have updated the way they do their revenue recognition policy to comply with Topic 606. This is to ensure pre-opening services get properly accounted for. And then lastly, enhanced financial disclosures. Companies provide more detailed disclosures in their financial statements to help clarify how revenue is recognized over the time. Some challenges I saw was impact on financial metrics, major change in upfront revenue recognition to deferred revenue recognition affected key financial alignments, and this had the potential to influence the investors' perceptions. I also saw complexity in revenue recognition. They must carefully assess if the pre-opening services are specific, performance obligations. This could mean they are subjective and require a lot more judgment and a lot more thorough digging through. And then I saw a lot of implementation costs. Adopting a new standard requires a lot of system modifications, consulting fees, and other additional resources that might be more challenging for privately owned businesses to get a hold of. Some benefits I saw, though, was improved decision-making. Stakeholders can then make more informed decisions based on standardized revenue recognition practices. Greater transparency, analysis, and investors have a higher benefit from more consistent revenue reporting, and this improves comparability across companies. And then lastly, I saw financial statement predictability as a good benefit. A new approach helps smooth revenue recognition, and this makes financial statements more predictable, especially for our managerial accountants who have to do that calculations. Cost I saw was potential misinterpretation. Deferred revenue recognition could appear as lower earnings, but this would require a careful evaluation of long-term profit. And then I also saw initial learning curve. They need to adjust their analysis methods to interpret financial statements under their new framework. Section F. I saw 3 big limitations. 1, complexity and interpretation issues. Some standards are still difficult to interpret, requires more judgment from the accountants. And then Topic 606 introduces subjectivity in determining performance. And the second one I saw was implementation cost and burden. Transition process for new updates can use a lot of resources, particularly for the small companies. Companies particularly and the private companies face high costs when implementing new standards, include staff training and system upgrades. And then the last one I saw was frequent updates and compliance challenges. Continuous amendments require these companies to regularly adjust their accounting policies, causing increasing compliance costs. And some companies have a hard time keeping up with evolving standards. This can lead to potential misstatements. So think about your mom and pop shops. They probably are going to have to require a lot more keeping up with it, and they could have a hard time, and some things probably fall under their cracks. And then some improvements I would suggest is simplifying disclosure requirements. Reducing the redundant disclosures could help business focus on material financial information, and this would provide more clarity for investors, because then they could focus on the actual numbers rather than a lengthy disclosure. And then I also saw increased stakeholder engagement. This could expand public comment periods and could help conduct more specific industry-specific consultations before putting into major changes. And lastly, I would improve transition support for private businesses. They should offer extended transition periods for additional practical accidents for private businesses so they can more ease into those compliance burdens and have more time to get help from their accountants or do their own research and make sure they're compliant in all the boards.